now the infrastructure has changed. And clearly we have misalignment with those actors because the fundamental ethos of crypto is to share the ownership, because we can be owner of network, we can be owner of dApp, we can be owner of set of smart contract. So the crypto world has some deep roots in the fact of creating common goods, I would say, that are valuable. We are trying to rebuild an infrastructure for stablecoin that is totally decentralized, profitable, and totally neutral.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic from 4RC. Today's show spotlights the up-and-coming stablecoin juggernaut behind USD0 called Usual. In this episode, we deep dive into Usual's design for a decentralized fiat-backed stablecoin offering a US Treasury bill yield, as well as why this protocol draws comparisons to a newly imagined DAO-controlled version of Tether. But before we do, just a quick word from our sponsors who make the Edge Podcast possible. Discover MERLIN Chain, the cutting-edge Bitcoin Layer 2, trusted with over $2 billion in total value locked. MERLIN revolutionizes Bitcoin by unlocking its true potential with native L1 assets, lightning-fast transactions, and ultra-low fees on an EVM-compatible network. Elevate your Bitcoin experience with MERLIN Chain today at merlinchain.io. Power up your portfolio by borrowing, lending, and multiplying your favorite assets, made safe and easy by the industry-leading automation tools at SUMMER.FI. SUMMER.FI offers a curated DeFi experience to access the highest quality protocols and strategies. Discover new earn strategies for your portfolio in a user-friendly app designed to filter based on the tokens you hold, the networks you transact on, the protocols you trust, and the highest available yields. Learn more today at SUMMER.FI, the best place to borrow and earn in DeFi. Tired of hopping between tabs, searching for new tokens before the hype catches on? Try Matcha.xyz, the DEX aggregator from 0x. Matcha connects hundreds of DEXs so you can trade millions of tokens and find fresh new drops. Matcha works out the best route to save you money on every trade. Swaps are free and Matcha has everything you need to trade on-chain. Gasless swaps, limit orders, and cross-chain, all in one place. Search Trade Done at matcha.xyz. Catch the tide of the mainnet launch of Puffer Finance. Whether you're an Ethereum staker or an aspiring node operator, Puffer delivers the decentralization revolution with its cutting-edge technology. Start with just 2 ETH to unlock the potential of native liquid restaking and maximize your earnings. Join the movement now and anchor your stake at puffer.fi. All right, let's introduce Adli and Pierre, the co-founders of Usual Money. Guys, welcome to the Edge Podcast. How are you doing?
Fine. Thank you for receiving us. It's an honor.
So you launched just a month ago, and we are looking now at about $200 million in deposits in your stablecoin USD0. We're going to talk all today about this enhanced T-bill yield that you can earn with USD0++. It is a remarkable accomplishment. I mean, it's not been an easy time to launch this summer. And so we're hoping that this will give folks a nice overview of this decentralized fiat-backed stablecoin. I like to think of it as Tether, if Tether were relaunched today on-chain with the intent of being, operated and owned by a DAO. So it's hopefully a great opportunity for folks to learn about here. Adli, why don't we start with more of that motivation behind Usual? Do you care to share just more about what prompted you and Pierre to get started and what exactly are you building here with Usual?
I think, in fact, the why is very important in our case because Tether has made a great job at their time. I'm in crypto since 11 years now. I've seen Tether rise. And I think it was a missing part, to have an exit in crypto world that was USD. So there is clearly a utility that was given by all that actor like Tether, Circle, etc. But now the infrastructure has changed, and clearly we have misalignment with those actors because the fundamental ethos of crypto is to share the ownership, because we can be owner of network, we can be owner of dApp, we can be owner of set of smart contract. So the crypto world has some deep roots in the fact of creating common goods, I would say, that are valuable. And what we are trying to build is to realign the fiat-backed stablecoin model, because we think it's the most efficient. And clearly, at the moment, the number I spoke about that. And what we think of something very important for the resilience and also the longevity of the stablecoins is to be neutral, is to be decentralized and profitable. And that's what we're trying to build. Because, Tether is profitable, clearly. It's not decentralized, clearly. But the neutrality is more complex because they are very linked to Bitfinex, maybe other exchange. Circle has deep link with Coinbase. And what all network needs is neutrality and agnosticism to be widely used and to have an open use of that. And I think that's what crypto gave us, like open stuff where we can build stuff with. And we need to keep that on the stablecoin business because it's one of the most important vertical in the crypto world. So basically, we are trying to rebuild an infrastructure for stablecoin that is totally decentralized, profitable, and totally neutral, without any exchange, without any DAO, and only one. We want to have all of them, And so the world of crypto can find a consensus on what is the future of his stablecoin. Maybe, Pierre, you want to add something because we can go also more on the political side, but I think that it's the main core value we have here, because we don't want to make something also that is just for the dream of making a common good. We think that incentive and all the tokenomics is very important to have a self-sustainable system and to have something where people can be owner, but can be owner, take decision, and have incentive to take decision and have incentive to maintain. And so that what we build clearly become a common good that live for itself and not something that need a private company behind.
I'm very aligned with that ethos and that incentive alignment kind of behind usual. I think maybe even before we get into what is usual and kind of defining it further, I'd love for one of you, maybe you, Pierre, just to talk about the size of the stablecoin market. Like, where are we right now with stablecoins? And, to use kind of the cliche analogy, what inning are we in? And then, like, how big can this industry get? Like, you two as experts working in this industry, like, where do you see it growing to?
Yeah, it's a very important question for a few reasons. First of all, the market is one of the biggest crypto market because stablecoins weight, I think, 150 billion of market cap. And also, like Adli said, those companies are the most profitable company of crypto, but also in TradFi. If you take a comparison, Tether has made more revenue than the biggest TradFi banks. And so what is going on is just that people behind crypto for liquidity just are paying some fees through the future cash flow through the interest of their money to Tether for having liquidity and stability in the system. So that's good, but we think that we are a momentum where normally this value that have been generated and not just only the revenue need to belong to the user. For the stablecoin market itself, I think it will be a huge market, and we are just at the beginning because stablecoin are just commercial money in certain sense. You have central money that are issued by central bank, and you have already a system that is issued by banks that are commercial money. Commercial money are a system that are just an old system where the communication between banks is not very useful, not very powerful in certain sense, where you have a lot of difficulties to communicate and exchange. And so stablecoin offer a new way to exchange value that are commercial money. And so in the future, we can bet that all the commercial money, all the value exchanges in between individuals will be just stablecoin, because it doesn't make sense to keep just the whole system that are the financial and commercial money. So clearly, the stablecoin market will worth trillions in the future, as the commercial money aujourd'hui worth more than 10 trillions of liquidity.
I think this is a great place for us to start to get into just how usual works. So if you can just start to explain like the mechanism behind it, and then we'll get into, you know, the differences between a USD 0 and this USD 0 plus plus.
I will go on the macro view. So, you know, like Adli said, usual is like a Tether onchain. The idea is to issue a stablecoin that is backed by a real-world asset, especially T-bills, for having no volatility on the collateral, because it's very important that the collateral of the stablecoin is the safest element that protect also the value of the stablecoin, to be sure that it's pegged 1-1. So usual stablecoin is backed by real-world asset. And the idea of usual is to distribute the value generated by issuers. And on stablecoins, you have two ways to distribute the value. You have some stablecoins that are yield-bearing, that are distributing the value through the revenue of the protocol. So they just decide to distribute the yield of the underlying. Some protocols are doing that. And we have chosen another approach that is also for alignment, and we distribute, let's say, the ownership, the part of the protocol itself directly through the usual token. So you have a stablecoin and you can do whatever you want as a mean of payment, lending, and so on. That is USD 0. And you have, according what you do with the stablecoin, a part of the value and the ownership of the protocol that is distributed to you through the usual token. And so maybe I will let Adli explaining what is the whole features, but clearly this offers a possibility for the user to benefit from the upside. When you have a yield-bearing stablecoin, you don't benefit to any upside. Let's say Ondo is scaling to billions, your stablecoin will worth $1 and will yield, let's say, the yield of the real-world asset behind, so 5%. Really, the objective of usual is to allow people to enter like they were at the beginning of Tether and to benefit from this growth, because if usual become Tether and maybe more in the future, the possibility for you to govern and to own a part of this issuer is huge.
And if I can add another important element, I think, on the fact of non-distributing directly the yield, but rather distributing the ownership, is that we often forget how strong it is to not distribute. Like if Warren Buffett was an asset manager, Berkshire will be like really with a slower growth, because when you keep all, your growth can be big in the treasury. And the beauty of what we are doing, and Apple has done the same before Steve Jobs' death, they don't distribute. They have started with Steve Jobs. So we think that this is really powerful, because you have like infinite compound interest in certain way on a common pot. And what the beauty of what we are building is like, we have to integrate everywhere, but we just want people to use. And when they use, they become owner, simply. So you have something that where you can keep your habits and just use as always you have been used stablecoin. And it's our job to make this smooth with UX, with integration, with liquidity, etc. But you just have to use, and you will be able to become owner. And if it become big, you can have a huge upside. But even if it don't become like big, you will still have the compound interest of that common pot. And that's something that is very powerful, because it's really a non-zero sum game in certain way. Because by collectively use the same thing, we all collectively create more value than just if we were putting together the value. So it's the beauty of building something like that. And if I go, tell me if you want to if you have any question. But if I go more micro, because Pierre was more macro, what we are building has three important components. What what we are building has three main components. So you have the first one that is the collateral. So that's where people deposit collateral, or where people that want to mint can say, okay, I bring 100 USDC. I need somebody that bring collateral. For the user, it's totally seamless. Just bring USDC and get USD0. But in front, there is like a reverse repo buy because we need to be always 100% collateralized. Just after, you have the USD0 level that is our stablecoin, that is pristine stablecoin with mint redemption 24/7. And this is like mean of payment, trading counterpart, like USDC, USDT. And after that, you have another level that is the USD0++. We call it bonds, even if it's like a staking also, but it's the fact of locking your USD0. So the USD0 are now in a escrowed contract in certain way, and you get USD0++ that is freely transferable. And this USD0++ is more our asset for saving, for collateral. And this is where you get the ownership. And our goal is to have this asset used everywhere in DeFi, in lending market, in yield market, in collateral for perps trading and stuff like that. And we work on that. And the beauty of this coexisting system is that you have something that is very pristine, one usable everywhere, and something that is more saving tools that is a little bit different in terms of architecture, because it's a lock, but the lock is not here for nothing. It's here because when we distribute token, in our case, we always distribute token against future cash flow for the DAO. So we in certain way forbid the mercenary capital logic, and we try to really give token against value always. And we will do that on all area where the protocol will distribute token. The goal is to always have long-term value in front and not short-term value, because we think that it's one of the most, I would say, critical flaws that tokenomics had right now in crypto is the short-term vision that a lot of project has. Okay, if you can grow big for 2 months, is not so interesting. What we want to build is to be there in 1 century, something like that. It's like the Vogue, if you know the Dutch Indian company that was like one of the biggest company in the world, and that's really what we want to build. We are not like here for building something that will disappear in few years. We are here to build a common good that can stay for long, and that's the beauty also of that kind of project that can scale a lot.
Guys, I kind of view Usual as this on-chain aggregator of these different US Treasury bill tokens. Is that kind of fair to say? I see you kind of nodding, so I hope I haven't butchered that. But I guess we should even kind of step back to say, okay, if you're aggregating these T-bill collaterals, what are they? Who is issuing these? And then I would also just love to know kind of like your criteria for who you bring on board to kind of underpin this whole system.
Yes, so currently on the market, since 2 years, we spoke about real-world assets since, I think, 6 years on crypto space. But really, since 2 years, there is a lot of tokenizers. And those tokenizers has decided to tokenize firstly some T-bills tokens. And that's very cool because I really think that the pristine liquidity, the pristine collateral is T-bills. And so they offer the possibility for DeFi to have an instrument that is yielding and that is backed by something that is real and that is very safe. So there is a lot of protocol like Hashnode, Ondo, BlackRock directly that are issuing some type of T-bills. But the problem with this liquidity is that this is totally fragmented. There is difficulty to have secondary markets because they are security token and they benefit from a clear setup in terms of regulation to protect also the token holders. But clearly, this is not very liquid in DeFi. So Usual act like an aggregator because for the moment we have only one collateral, but on the long run we will integrate few other collateral like BlackRock. And the idea is to mix them and to offer on top of them a stablecoin that is a better version of USDT and USDC. Because clearly, currently, USDT and USDC are backed by T-bills. They are backed by few banks' deposits, but mainly by T-bills. And this is also a very important point for stablecoin, because we remember what happened when SVB, make bankruptcy. Circle just depeg a little bit. Circle depeg because a part of the USDC collateral was in SVB, and somehow the market was scared to not refund 100% of the fund. Having a stablecoin that is not backed by any bank deposit, so that is not linked to fractional reserve risk, is very important. And so it's why also we aggregate only as a collateral T-bills token that are very short-term T-bill token to ensure that also behind the redemption of the USD0 that is the stablecoin of usual, we are sure to be fully liquid. But yes, in certain sense, we can consider that usual and especially USD0, it's like a pivot, a bridge between real world asset liquidity that is not very liquid these days, and try to unify this liquidity and offer that is a direct link with real world asset liquidity with DeFi. And so that's clearly one good aspect of usual in certain sense.
Guys, I want to shift into some rapid fire questions. I really want to draw out all of the thinking that I've personally gone through, in terms of, am I going to mint USD0? Should I then put that into USD0++? I'm imagining users are going to run into this if they go to usual.money and, log into the app after this. So none of this is financial advice, but I hope it gives some guidance, at least in terms of how I've thought about it, how we as users might think about the different choices to make here. So first off, in terms of the minting, quote unquote, of USD0, can you remind us, is there a minimum to actually mint with a collateral, or are we essentially swapping for USD0 with smaller amounts of money?
So we have try to abstract the difficulty in the UX the more we can. So what we have made is that there is a sort of smart routing. If you have something more interesting in terms of pricing that is on secondary market, for example, if there is a few waves deviation, there will be no mint. So we never print if there is no demand for it in certain way. And so you always have the best execution strategy. And in terms of rules, it's pretty simple. For the moment, there is no primary market mint under 20K. This is for optimization reason of gas and stuff like that. And also because, the collateral contract that is originally permission for user with 100K at least. So generally, they will not mint less. And it's more optimized like that, I would say. So yeah, only two rules, very simple. If there is a better opportunity on the secondary market, you will go through the secondary market, whatever the amount. And if you go primary, it will be only above 20K. So, and all that is not directly shown in the UI, I would say. We always tell you what route you take, but we don't explain why, and not always, because we explain of some user guidance stuff, but we try to really abstract the difficulty on the product, and we care about that, and we really want to continue on that way to provide you, like you say, a road to follow during the onboarding and even during your discovery of the dApp.
No, that helps a lot. So for most of us that could be using let's say hundreds or even thousands of dollars in stable coins, the app nicely abstracts away all of that. I think it routed me through Paraswap when I was using it. For someone though who's working with $100,000 or more, potentially millions, can you just remind us they can use the app permissionlessly, right? They go in and it will mint, and I'll see some sort of signal or indication that I'm actually minting and not swapping.
It's depending the routing. It's display just on the under your transaction screen, I would say, before doing the transaction for sure. You see if it's Paraswap or usual counter, because we have made some metaphorical sub menu, I would say, to display the place of usual. And so when you mint, you go at the counter and you can make your deposit and get USD0 in front.
Yeah, it's very straightforward. If you have a big amount, you go directly to the primary market to not unbalance the pool. And at this moment, what will happen is that someone provides for you the collateral if you go through USDC. So someone is buying for you the collateral and putting that in the collateral smart contract, allowing you to have some USD0. So it will take maybe a few seconds, but you will deposit USDC and you will receive a number of USD0 that is close to the USDC, because we take the USDC price. So you can have a small difference depending of what is the current price of USDC on the market currently. But if USDC is pegged 1.1, you will receive 1 USD0 for 1 USD.
Okay, so the most important question that came up for me as I was going to mint was, all right, what happens if this thing falls below peg? And, from experience, we know that with a mechanism like this, if USD0, this is not USD0 plus, if USD0 falls below, let's say $1, are we to expect that anyone could potentially buy that at a discount and then redeem it permissionlessly through the app? Or do we have to rely upon some sort of arbitrager, kind of like a market maker, partner, whale, someone like that?
It's like anyone that is registered for the USYC collateral. So it's not anyone, but theoretically, you just have to KYC at Hashnode. We may have others collateral with different restriction. It will follow the restriction of the collateral. So there is no there is no add-on of restriction by usual. It's like the restriction of the initial token of collateral. So I would say that it's open to anyone that can hold USYC, like it will be open to anyone that can hold Euro USG, for example, of Ondo or any of that kind of asset that will back the stablecoin. And we also have contract with market makers to monitor the market and doing the arbitrage. And last resort, arbitrage, backstop liquidity, that kind of stuff. So, yeah, we're pretty secure on the USD0 peg. And to be honest, we already live our stress test, I would say, with this Monday in August that everybody remind, I think, where we only had 30 bips deviation. So for 1 month and a half, less than 1 month and a half stablecoin, I think it was a good test, and we passed it pretty successfully. And yeah, on that side, we have more flexibility than Circle and Tether, because really you just interact with a smart contract. You even doesn't have to go on some centralized website or institution, or it's permissionless. It's just that the token is not permissionless, but the action is permissionless. And so the more we'll be bigger, the more we have a institution around, the more the peg will be efficient and the arbitrage will be efficient.
Yeah, you can redeem whenever you want the collateral, so 24/7. This will allow us to make an arbitrage and make also every people that are registered to access to the collateral to make the arbitrage. So it's quite powerful, and that can ensure also to have a strong peg. I think if you want to see the peg of the stablecoin, you just have to go on CoinGecko or CoinMarketCap, and you see that the peg of USD0, even if the last Monday was tough on the market, hold the peg very well. It's also because we have, and certain people also redeem the TVL in order to keep the balance of the pool and to be sure that the stablecoin is well pegged to the dollar.
Yeah, I think if you go to CoinGecko and you look up USD0, as far as I know, it didn't even fall 1%, below that peg. And that was a pretty intense market correction for crypto. So to your point, great stress test. Obviously, we know there's probably more stress tests ahead, but I think it was a good sort of timing to see this hold up after nearly 4 weeks and building up nearly 200 million in liquidity. So let's say I've now got my USD0. I'm thinking about potentially using it in like a USD0 related DeFi opportunity, maybe like a Curve LP, or I could actually just mint this USD0++. Can you talk to us about the USD0++? If I were to like mint that, or like think of it as almost like locking it up, just what are some of the mechanics there? Like how long is it locked up for? What does that USD0++ represent? What sort of yield is it? Where does the yield come from?
Sure. Maybe I can start. So the minting of USD0++ is like the minting of USD0. So you choose the best road. If there is a USD0++ that is cheaper than the primary market, you go on the secondary market. If not, you create new USD0++. USD0++ is a token that wrap your USD0 that will be locked during 4 years, and that is equal to a bond, a liquid bond, because your bond, your USD0++ is liquid on secondary market. Currently, we have deep liquidity on Curve. I think we are in the top 5 Curve pool. In terms of liquidity, we have more than 60 million of liquidity. And so you can exit also your position through the secondary market. So USD0++ is like an enhanced T-bill in a certain sense, DeFi T-bill, because it will give you, not for now, but just after the TG, the possibility to claim a yield in usual first, or at least the risk-free yield. And that's the beauty of this mechanism, is that we offer you the possibility to claim some share of the protocol through a yield that will be also depending of the value of the usual. So if people bet on the growth of the usual, the yield in usual through the USD0++ will be higher than the risk-free yield. And at least they can claim the yield in a form of USD0 equal to the yield of the real world asset behind, so close to 6% currently, depending on the floating liquidity. So we call it that enhanced T-bill, but it's like a boosted T-bill. And like Adli said, the idea is to diffuse and distribute this product as a collateral for DeFi, because it's backed by a pristine collateral that is just T-bill. It's a locked version of the stablecoin, so you go to the secondary market to exit, but it guarantees you at least to have a performance that is a little bit better than the risk-free yield. And so that's a product that can create also a good collateral for DeFi product, because it's clearly something that is not existing for the moment on the DeFi. And it's also a way for us to distribute the ownership of the protocol. One point about the 4 years. Why 4 years? Especially because there is a lot of tokenomics that are working on 4 years, CRV for instance. And the idea is to be sure that every time we distribute some usual token, this will be related to a revenue for the protocol. Because Adli mentioned that, and that's very important. There is a lot of governance tokens on the market that are not linked to everything, just linked to the governance. And so we can ask to ourselves, what is the value of a governance token that is not backed by a revenue? I really think that is pure speculation, There is no real value for something that is not backed by a financial revenue. So clearly the idea is to be sure through the locking of the USD0 that we have something that keeps the value, keep generating revenue for the protocol. And so if we distribute to the user some usual token, this will have a real value during the time of the revenue of the protocol. So that was that idea. And we work a lot on tokenomics to improve something that is fair, transparent, and this is very important. Transparency and tokenomics are very important to avoid also any dilutions against the user that is in benefit from insiders, investors, and so on. So that's very important for us in usual, but also to be sure that the model is sustainable. Distributing usual token will not go to zero because people will sell the governance token because behind there is nothing. So that's the purpose of USD0++. The way for us to conceptualize, the tokenomics.
Yeah, if I'm drawing lines here then between usual money and Tether, it's important to note that the USD0 is, to what Tether is, USDT. And that's the product that we've all enjoyed over the years. That's the stablecoin that's so enormous here, in DeFi. However, the USD0++, that has no sort of like analog in Tether. Like that's what the team at Tether, the ownership of Tether, like the insiders, insiders might have a negative association. Just they're a private company. So, call it what it is. Like they've done extremely well, and that USD0++ is not necessary for them because they're able to use, all of that collateral to ultimately earn T-bill yield or whatever else they do with it. Whereas like this is bringing that all on chain and it's the opportunity here for us to earn some bit of that yield ourselves, and to have some bit of that yield be shared by the usual money token holders. Hey everyone, before we get back to the show, excited to tell you about a new omni-chain Bitcoin solution called FBTC, which has already surpassed $125 million in TVL and become the fastest growing BTCFi asset this summer. The FBTC Points Campaign Sparkle offers sustainable yields plus points and token airdrops from strategic partners such as Babylon, Mantle's new token Cook, and more. To learn more, visit fbtc.com/ongoing-campaign. And special thanks to FBTC for sponsoring us at the Edge Podcast. So there's one last rapid fire question I wanted to cover, which was just kind of diving into some of the yield opportunities. We're not going to be able to cover them all here. I also my hope is that folks listen to this into the future. And so some of those opportunities might go stale. But can you call out just what are some of the yield opportunities available now, whether it's USD0 or USD0++? I noted also that as of this recording, just today, there was a new origami vault launched for some looping. So there's simpler strategies like a curve LP, maybe we could talk about. I'm sure there's lending opportunities, maybe with a morpho, but then we've got these more advanced looping vaults through something like origami.
Yeah, clearly. What we are trying to build, little by little with integration, is to allow, I would say, diversity of activities and combo. So people that can combine activities, because origami, for example, offers some Ori tokens that will be distributed. There is a Morpho token that will be distributed also when you use Morpho. So the goal is also to make integration with protocols that will distribute also a share of their value, I would say. And by doing that, clearly it's a growth strategy. We can say that it's the contrary, but it's also to give utility to the token. And we focus on USD0++ first because we think that USD0 usage need a little bit more of network effect and liquidity. The yield can start at zero. You can have a DeFi project that just open a vault, in one day and have some liquidity that grow, etc. But tomorrow I want to make a mean of payment. If I have only $10, my mean of payment is nothing. So that's why we are more on the yield logic, and so to have the more usage of USD0 and more liquidity for both assets, because we need liquidity on both assets. There is different strategy, because if you are really believer in us, and in usual, you can buy many YT on Pendle, for example, because you will have crazy exposure. And you can also make the math to see if it's more worth it on Pendle or to do a Morpho big leverage loop. Because at some point you pay a rate on a side, and you pay directly the future pills and so token on Pendle. But what we are trying to do also is with origami is to make automation more easy for the people who are speaking with other platforms like that, like Contago, etc. We have, I think, 20 integration in the pipe. There is pretty big ones that will come also. There is a multi-chain also usage that we want to start to work on. I can say that we also have one chain that is okay to allow us to be a gas token, so it's not nothing. And yeah, clearly the goal is to spread on the collateral usage of USD0++ now, and after starting to spread the mean of payment and trending counterpart logic for USD0. And we have some strategy on that also that we'll start building volume around USD0 with other pairs. Because if you look at carefully, we haven't incentivized any directional asset pool right now with USD0. So we really not focus on the spot role, the trading counterpart role of the USD0. It will come soon with BTC, stuff like that. But clearly, yeah, the first goal for us is to have people see if there is appetite for locking the USD0, etc., for using it as a collateral. And we see that this usage start to be great, and we continue to add bricks, I will say, and we will start to give first brick for USD0 also as a trading counterpart usage, and maybe also some mean of payment. We already have a nice conversation with OLEL. We are very close, so people can already use OLEL with our stablecoin because it will make a swap, and at the end the counterpart is USDC. So the goal will be to have direct counterparty for OLEL, Gnosis Pay, other services like that, and maybe even also integrate some merchant app. And I think it's a nice walk around where we are, but clearly there is for any needs. If you want to be exposed even without our stablecoin, you can, because you can deposit on USDC in Morpho and Pills. You can also deposit with USD0 another stablecoin, and you will earn also Pills. So we really try to be interesting for any risk profile and any logic people will have. And yeah, I think there is great opportunity right now, because the more earlier you are, the more it is good for you, because the Pills period is a one-time period where there will be never as token distributed per dollar in certain way, because after our tokenomics is disinflationary, so there will be never that amount of ownership per dollar deposited per day, and so that's why it's a great opportunity to participate.
Yeah, let's dive into this, what you're calling it, the pre-launch phase a little bit more. So you're in this pre-launch phase, obviously a growth phase for usual. Your pre-token, so the usual token, the governance token, and this utility kind of revenue share token is not live yet. Maybe kind of quickly talk about this pre-launch phase, but also what should we expect for what comes next after the pre-launch phase, after we're out of that?
So very transparent. We have already announced that the pre-launch phase will distribute 7.5% of the supply through the airdrop. The airdrop will happen before the end of the year, and the idea is to have a TGE mid-November that will start distributing some usual token. So everything is prepared, but we will announce that I think 1 month before the TGE. And the idea is to leave the period of points to a normal period where the USD0++ plus all the integration will yield in usual. So this period is a way for us to bootstrap the liquidity, to install enough liquidity for the system to work. But really, we think that the explosiveness of the protocol and the explosiveness of the growth will happen just before the TGE, because all the systems have been designed not to be a system of points where people just speculate on points. We have a system where the tokenomics have been created since 2 years with a lot of agent modeling to be sure that this will also create a good upside for people that are at the beginning of the project. And really, the idea behind that is to say to users, okay, you have one time more opportunity to recreate a Tether. You were not there because it was a centralized company, and you were not there at the beginning. But here we are creating something for the DeFi that will be neutral in the future, that will be used with all the DeFi partners because we don't have any competitors. Really, we want to work all together to create some synergy with them. And we can say to the user of the DeFi user, okay, you have one new opportunity to recreate a Tether on-chain and to benefit from the upside. And so this will happen during the pre-launch phase, but this will continue also at TGE when people, if they continue to provide liquidity, will be owner of the structure and the protocol. So that's the plan. And really, on the long term, the idea of Usual is not to stick just with one product. We have already plenty of products that are currently ongoing, that are building. And so next to the stablecoin, we will have also other products that will be announced and that will increase also the profitability of the DAO. That is really like a common pot where people just put all the revenue that normally have been privatized by centralized entity, and they earn some ownership of the structure here.
It's like delegating to collective intelligence your profit from stablecoin you own simply. And the goal is we think that by being collective, we can make even better profit and have better vision. And it will be important to find a way to have good governance system also. And that's why the token is the heart of the project,
At Moonbeam, we're building a world where the wonders of decentralized technology are accessible to everyone. We're advancing Web3 integration through product enhancements, funding for innovation, and investment in our partner ecosystem. Our product roadmap includes ZK initiatives, tokenomics updates, and 8x throughput. Our $10 million innovation fund invests in startups that deliver cutting-edge solutions for RWAs and Web3 gaming, and our partner ecosystem continues to grow through grants and incentives. Moonbeams is delivering frictionless user and builder experiences to create the future of the internet on-chain. Join us by participating in the Moonrise campaign today.
One criticism I've heard from folks about all of the different T-bill yield related products in DeFi is just like, what happens if we go back to a low yield environment? If you go back to the great financial crisis, I think even, even like 10 years or so after that, we were still looking at like these sub 1% interest rates, like near zero. And so we've had these higher interest rates for just the last 2 years, or I think even less than 2 years as of this recording. And so how are you thinking about that? Like, if we were to go back to a low yield environment, do you have ideas for how Usual would handle that?
Now, on that, I think there is a different way of seeing it, clearly. So first, we can say that it's better than nothing, but it's not sufficient. But it's better than nothing because when there was 50 bips, the 50 bips was taken by the issuer also. But it's not the answer everybody we want to hear. So what we can do, and it will be, I think, a collective decision also, because it touches the risk management, so it's very important, is that there is other bonds product. You can also have corporate bonds that can yield more than just the Fed rate, for example, but it implies a little bit of more risk, so it's always, risk-reward. What we can do also is that at the moment, the collateral is fully untouched. But this collateral could also serve for liquidity, for example, on some market, because people want to trade T-bills. So we can also optimize the yield of the collateral. Last but not least, as Pierre said, we aim to launch others product and not only launch a stablecoin backed by a money market fund and T-bill. We want to launch also, I would say, DeFi stablecoin, maybe backed by staked USDE, staked Go, staked Frax, etc. That could provide another, a source of return for another usage, and fully separated. We also seem to create some E0 that will be backed by LRT, LST, etc. And always the same logic. Collateral layer, zero layer, pristine, only directional, no yield bearing, and plus layer, you get Gov token according the underlying yield that is generated by the collateral. And so it's always fair because if the yield is decreasing on one asset, you will have less governance token. If the yield is decreasing on another asset, etc., etc. So it's only an overview of few plans we have in mind because we also have other product in our vision of that. But clearly, I think this is not a threat for us because we have many ways of optimizing the yield. We have many ways of having relay of growth in terms of yield elsewhere. And even if we don't have that, it's still okay because, when the yield will go down, we can think valuation of Tether will go down. And whatever, if they have a 1 trillion asset under management, they will still make money. And with the treasury, we can also invest this money. The treasury, with revenues that was made, we can make Michael Saylor with the treasury in certain way also if people of the DAO want that. So
really, the first product is to be a stablecoin issuer, but at the end we can consider usual like a decentralized banking protocol or maybe a decentralized BlackRock. Clearly, the idea is to have various other products, and like Adli said, offering a DeFi stablecoin that is backed by also various stablecoin like SDAI, Takkal USD, and so on, that bring us another source of revenue for the protocol. It's also acting like the first product of the real world asset stablecoin because we unify the liquidity of a lot of DeFi stablecoin that are fragmented also, and we create something that is a stablecoin on top that can be redeemed with the collateral, but earn another source of revenue. This is the liquidity layer for the decentralized issuer that usually is. And on top of this liquidity, we can create also various services like TapChain dedicated to payment, like financial services on top of our product. So really, we see usual like a protocol that can be like the next future for a bank in the future when TradFi and DeFi will have merged. Usual is like a fully decentralized company that aim to create also various services that are not just linked to the commercial money. Because if you are taking the example of a bank is issuing commercial money through the fact that people deposit and they lend this money, and through the ratio of the central bank and so on. Clearly, the first product of Usual is quite like that, but in the long term, the real idea is to offer also various services, and banks are offering also various other services in the normal world. So we really want also to diversify, and all these services will also generate revenue, and that this common pot will increase and so give a strong and sustainable value for the Usual token on the long run.
I think kind of what you both walked through is probably the most interesting holistic vision of Usual that I wasn't even aware of myself. But and just to like reiterate a few things, I mean, you're not pigeonholed to just this, I guess, TradFi rate on T-bills, because there's plans to basically go after the DeFi rate as well. And I think when we all saw the DeFi rate collapsing in the last cycle, everyone kind of moved to this kind of TradFi yield. And I think to be able to play in both markets is, in the end, probably the most optimal, I would say.
Yeah, we want to build something anti-fragile. Really, that's the goal. We release the first step, but it's a step, and the stairway to even is like quite long. So clearly, that's the goal. The goal is to provide something that is like, I like the pendle metaphoric design, because it's like that. And I think with what we build, we are able to have something like that with the mix of TradFi and crypto. And sorry for interruption, but this was
great,
too tempting.
and I think like we're almost near the end of time here, guys. But I think just to kind of bring this back to, I'm curious to just from like a regulatory purview, how you're handling, at at the end of the day, bringing all these revenues and fees kind of back to that usual token, how exactly do you navigate that? What's been a very difficult, I'd say, regulatory climate to achieve something like this? So how are you looking at that?
First, we are working with regulators, and that's very important. I'm a former policymaker, so it would be a shame to not do that. So that's very important to discuss with regulators, because regulators want to, certain sense, they want to have the common good. So clearly, discussing with what we are building is also for them interesting. So in Europe, we have the chance to have a regulatory climate that is quite transparent, quite clear. And as we are decentralized, we will maybe be regulated with the next law. But currently, we are discussing on AML and so on. But this is just an ongoing discussion. For the regulatory purpose on security, that is also mainly the subject in US. We really think that it's very important that US also clarifies the position, not just on stablecoin, because I think we will have something in the next few months, but also on the security aspects. Because what is the problem on the DeFi and the crypto market these days is that people are aping on memcoin that has no real value, because asset that has real value and protocol that are generated good revenue that are shared to the users are attacked by regulators. So in certain sense, this is a subject that will be clarified, I think, in the future, because I think people will be clever and there will be a good direction that will be taken. But for the moment, usual token is just a governance token, and maybe in the future, like Uniswap, we will let the governance decide what they want to do. If they want to claim also the revenue that have been generated in the treasury of the protocol, or if they just want to be a governance token. And so this is clearly a path that will be taken by the governance in the next few years, when the protocol will be mature, when the protocol will be fully decentralized, because the idea behind usual is that after creating the protocol, everything will be decentralized the most possible, and so clearly this will be a subject that will be depending of what will be the regulation in few years. I really think that there will be a clarification in the next months, because crypto is a future. I cannot consider that the status quo on what is a security token is a good thing for all citizens, because the value that has been generated by this company, if this company want to share it to the user, normally it is a common good. You don't need to forbid this distribution of value to the user if they are bringing value. So for the moment, there is like a protection of centralized actors, and I really think that in the future there will be no choice to consider that what is a real value token is something that is also generate value and distribute also this value that is correlated to a cash flow. And that's I think quite important. And we will have a better ecosystem when the regulation will allow that also.
Pierre, Adli, I think this is a great place for us to start to wrap up. So I want to remind our listeners that they can learn more about Usual by going to usual.money. They can follow Usual Money on Twitter for more updates. They should follow your personal accounts at Adli TB, which is Adli's, and then Pierre's is Pierre_person. Pierre's missing the E, and we'll put the specifics of that into our show notes so you can easily reference that. Guys, thanks for coming on. Such an easy conversation to listen to. Stablecoins are so important to the lifeblood of DeFi. The fact that you've reached 200 million in about 4 weeks is just insane. Obviously, there's a long way to go. I can absolutely imagine us, being at the $1 billion mark by the end of the year, and hopefully much further in the coming years here. I'd love to close out, though, with just like any call to action with the Usual Pills program, the points program. How much longer is that going to run? And then I guess it's also important to note, like, when again is the token expected? And, should we expect the PILS program to continue after token launch? And otherwise, thank you so much for coming on. Just like I said, real pleasure to hang out, talk DeFi, and dig into all of this.
Thank you to you. Maybe a few words about the pre-launch phase. So you are at the beginning because there is 3 months remaining. The idea is that the pre-launch phase will end around mid-November, just after the US election. And at this moment, it will be the TGE. So usual token will be distributed to the bond holders, so the USDT or plus order, and the airdrop will happen in the next days. Currently, the idea is to have an airdrop that will be given to people that have participated to the pre-launch phase, and they will receive 7.5% of the supply. We will communicate on all these elements before the end of the pre-launch phase, but we are fully transparent on what is the supply and what will be distributed to the participants. And like we said, I think it's the best moment to earn per dollars the maximum amount of usual during this period, because it's a bootstrapping period, and so people will receive a very higher amount of usual through the airdrops and ever it would be distributed during the whole life of the protocol.
Thanks everyone for tuning in. If you're a talented founder or developer, please consider reaching out to our team at fourthrevolution.capital. And for future episodes of the Edge podcast, please check out our link tree at edge_pod.